You likely already know by now that the watch market and watch brands are having a hard time. Watches aren't flowing over the counter the way they did back in 2020. But it's worse than you imagined. The watch market is doing way worse than you realize. It's bad, really bad. Tudor's dead, Patek is hit and miss, and Rolex, they are nowhere near as desirable as everyone thinks. Quite the contrary, actually. If you're thinking of watches as an investment, then don't. It's a really bad idea. And I have the charts to prove it. Let's dive in. By now, we all know that the watch market is in a downturn. Things are not going well for luxury watchmakers. Richemont, LVMH, Swatch Group all had less than stellar 2023s. People are buying fewer watches, and those watches are sitting on shelves for much longer periods of time. The problem's compounded by the fact that watch producers ordered far too many parts, far too many materials, and far too many components last year. And now they're sitting in with excess inventory. Longines sold almost 250,000 watches fewer last year than the year before. According to the Morgan Stanley report, Tudor sold fewer watches last year than they did in 2021. In pure volume, Omega is flat since 2021. Part of this is down to wanting to sell fewer watches at a higher price. But overall, these brands don't want their volumes to stagnate or drop the way that they have. There are multiple component manufacturers that have had to send people home from work, asking them to go onto half schedules simply because the orders aren't coming in. Some manufacturers are closing production for the summer early because there's no work. Now, as consumers, we can have some level of schadenfreude towards the luxury brands because of their predatory pricing over the last years. But the downturn for now has some very real consequences for regular people who are not in a great place because the market just is not where it used to be. Now, how bad is it? Well, this time around, I'm looking at it from a secondary market perspective. Compared to 2021, the overall market index for secondary prices is only 6% higher. That's an increase, I know. But 6% in 3 years is almost disastrous. For comparison, the S&P 500 index is tracking at 26% for the same time period. The NASDAQ Composite Index is close to 31% up since 2021. The watch market is in a terrible place when it's viewed from that lens. But it is even worse for the manufacturers because the implication is that if the secondary market prices are down, then inventory at the retail level is not flying off the shelves, at least not at retail pricing. If you take into account that the inflation rate for every year since 2021 has been somewhere between 4.5% and 8% per year, and a secondary market that has only gone up by 2% on average per year, that means those brands are potentially making a whole lot less profit at retail level. And it also has implications for the overall growth of the secondary market. Some of those manufacturers might be losing money. My guess is that this is not a great time for you to start out as a new grey watch market dealer, depending, of course, on what watches you trade in. This, again, is bad news for those watch brands, but also for us. And Watches and Wonders in 2024 was actually proof of this. Watches and Wonders was a little bit disappointing this year for the simple reason that a lot of the brands played it safe. They didn't throw out a ton of new models. Rolex was massively restrained. Tudor kept it relatively simple. Omega, I know they weren't at Watches and Wonders, but so far they've done a Whitespeed Master, and that's pretty much it. So far it's turning out to be a story of iterations and safe bets and not that many innovations and new ideas. And sure, that Black Bay monochrome is vanilla for a reason, because those kind of watches sell, but they don't generate excitement. They don't speak to enthusiasts or regular customers in a way that draws them into the store to take a look. So it's not a great time for brands, and in some ways, not that much fun for us either. But okay, discounts are great, so, we like them. So how did I get all this insight? Well, a while back I did a video on the Morgan Stanley report talking about the winners and the losers of the watch world in 2023. Because of that video, the people over at Watch Charts reached out to me and they asked if we could do something together. We had a little bit of a back and forth and we decided to do this little mini cooperation. I haven't received any money for the cooperation. What they are paying me is in data because I needed the data for the video. And I'm of course telling you that I got the data from Watch Charts. The hype is over for Tudor. They have had all of our attention to the extent that for a period of time, it was better to put the word Tudor in your thumbnail than Rolex. Just go to Adrian Barker's YouTube channel and compare his latest view numbers on his Tudor videos compared to the view count on something like his IWC or Bremont videos. Nobody cares about IWC and Bremont in the way that they care about Tudor. Personally, I've been saying for a while that Tudor is on their way into the boring or vanilla phase. And by the vanilla phase, I mean that the really innovative, non-limited releases are going to be fewer and more far between. They've got a good lineup with the Pelagos, the FXDs, the Black Bays, and they don't really need to add a lot to their catalog. A safe monochrome Black Bay 41 that is an iteration on the previous version is going to be more the norm. And yeah, they'll do a Milan Football Club edition every now and again that you can't buy, and they're limited, but the core catalog is in a stable mode, and the hype's dying. This is where I give you the first chart, and I know charts are great. What you're seeing is the secondary pricing for all new Tudor models released since 2021 relative to the retail price. So index 100 is the retail price. What you should be noticing is three things. When any new model got released, there was always a bump, a short period of time where the price traded quite high. That is what I call the don't buy hump. This was when production wasn't fully up and running, flippers and grey market dealers were trying to cash in on the hype, and prices got inflated. But that bump drops off on every single Tudor watch released. Before the peak of the market, so before 2022, the bump was bigger and the starting point was higher. But even after the peak, where the market was generally trending lower, the new Tudors still exhibit this initial hype bump type of behavior. Which leads us to the second thing. There is not one watch that has increased in value since the initial release bump. They have all, without exception, continued to fall, even the Black Bay 54. And finally, not one of these Tudors released in the last 3 years is going above retail at the moment. The secondary market prices for Tudor overall, so all tracked traded stock, is trading 15% below where it traded in 2021. This data tells me that Tudor just generally is not going to hold its value, and that their desirability, which I think is what these numbers are a good indicator of, has clearly declined over the last 3 years. The initial bump barely takes new models above retail now, and over time, they all trade below retail. The data seems to be fairly clear. The hype, as far as I can tell, is gone for Tudor. I'd be curious to hear in the comments who you think is poised to take their place. Then we have Patek. Same graph as Tudor. Similar in some ways, but also a very different story in some other ways. So the Tudor graph, all watches had a bump and all the watches bumped to above retail initially. Why? Because Tudor was hyper popular and people wanted anything Tudor. That's my argument at least. Now Patek, for almost all models released since 2021, they do have some level of bump, but not all of them have significant bumps. The exceptions are watches like the two Calatravas and the 5224. Generally though, you get this short period of time post-release where the watch is at its absolute highest, and just like Tudor, the watch declines from there. Again, there are one or two exceptions, the 5968G that also had a brief resurgence, but all eventually follow this declining trend, which of course makes sense since the market is also overall declining. But there's also something else that's interesting. Not every Patek gets and instantly trades above retail. The 611G has traded below retail since its launch. The 5905 is trading below retail. The 6007G is below retail. Out of 15 releases in 3 years, only 4 are trading more than 10% above retail. Now, if you don't find this fascinating, then there's clearly something wrong with you, or well, maybe it's me that just freaks out about graphs. But broadly speaking, Patek models seem to be a bit hit or miss in terms of their popularity. Where the graph for Tudor shows that everything Tudor has been initially popular, it's just not the case with Patek. For Patek, buyers look at a small portion of their watches and go absolutely mental, and it stays relatively mental. But for a large portion of Patek watches, they are met with a level of indifference. What this says to me is that Patek aren't and haven't been quite the hype brand that Tudor have. Patek have more been about a couple of hype watches and a lot of relatively less desirable inventory. That feeling that I've had every now and again that not all Patek releases are particularly good, well, I feel it shows in the numbers. The 6007G, which I criticized a fair bit, is not generally liked by other people either. It's not that it doesn't sell, but more people want to sell it than there are people that want to buy it, and that's why it's trading below retail. As a brand in general, though, Patek are doing fine. With an overall market index of 26% in increases, they are, as a brand, essentially performing a lot like the stock market. But underlying that, I think they are massively dependent on those hype pieces and then the ultra-limited high-end collector and long-term customer-centric models that aren't the new releases, but rather their core classics. The watches I'm talking about are the ones that are the John Mayer watches, the Ed Sheeran watches, the ones that they get to buy, and not those year-to-year new releases. The watches that do the heavy lifting are the ones that by far are the hardest to get a hold of. Those are the models that seem to be holding Patek up, and then there's a lot of comparatively meh inventory. To me, it says again that it's not the brand, but specific watches that are in demand. They aren't quite the powerhouse in terms of numbers that a lot of people would like us to believe to some extent. And then there's Rolex. Now, try to refrain from inserting your Rolex rant in the comment below, but if you can't help yourself, then all the power to you. Same graph, but again, here's the fun part. The Rolex watches don't behave quite in the same way as Tudor or Patek. Remember, Tudor got a bump on all models because all models were viewed as popular and because Tudor has been the hype brand. Patek had a big bump on some and not so much on others. Based on the sample size, Rolex generally doesn't seem to have that same trend across all models. Except for maybe the full gold GMT Master 2 with the grey and black bezel, most models are released, go up to some sort of position and kind of more or less stay there with only a small decline over time. Their watches behave differently, and the difference between their highest points and their current point is the smallest of the three brands for those newly released watches. I think this is down to the fact that a Rolex watch's popularity is easy to assess before release. We don't know for sure if a 6007G is going to be popular or not, but we know how popular a Daytona is going to be. We and the grey dealers know how popular a two-tone sub will be. The popularity of Rolex watches is incredibly predictable, I think. So there's going to be less of a bump, and demand prediction is just going to be more consistent. What else is interesting about Rolex? The steel models of the GMT Masters and the Daytonas are the ones that really go high. Two-tone doesn't trade high, and watches at the fringes of their catalog, so the Explorer 2s and the 1908s, they don't do as well. None of this should be surprising because intuitively most of us already kind of knew this. Largely though, Rolex is desirable, but it's those perennial favorites that really command the premium. It's not just because it's a Rolex. The data doesn't support that conclusion. Also, surprisingly, for the period Rolex is at index 98. They are in a slightly worse place than they were in 2021 in terms of desirability. They are also, compared to all the brands in the Watch Charts database, performing worse than the market on average, which was at 6% for the period. Worse than market. You can't tell me that you would have guessed that. Most people, including myself, would have assumed that Rolex was at least performing better than the general market trend, but it's not the case. I think most of us have been conditioned to some extent to believe that anything Rolex is going to be popular, but it's just not true. When you factor in hundreds of thousands of Datejust sold and Oyster Perpetuals, the argument that Rolex is desirable and holds its value as a brand is only partially accurate. If you got your hands on every Rolex model that was released since 2021, you would theoretically be in the money right now. But that would be massively driven by the Yachtmaster in titanium and the Daytonas, and the rest is going to be so-so at best. And it's all dependent on you getting these watches at retail and babying them for the entire time you own them. I mean, good luck with that. Anything bought at secondary pricing upon release would have netted you a loss right now. The angle that I keep coming back to is that all these numbers to some extent puncture the illusion that Rolex is this ultra desirable brand. I've made the observation a couple of times now that, with Rolex selling 1.2 million watches, you're more likely to meet a person wearing a Rolex than someone wearing a Tag Heuer. So sure, on the one hand, Rolex is likely more desirable than Tag, but the reality is that Rolex is also more commonplace, which to me is the antithesis of desirability and status. Patek puts out less than 60 or 70,000 watches a year, and it's the highly limited, highly desirable models and the generally limited nature of Patek that keeps the demand high, giving them an overall market increase of 26%. Those heavy hitters proper Patek overall. But with 1.2 million watches, the Yachtmaster in titanium can't correct for an overall lack of interest for a lot of variants of Datejusts and Oyster Perpetuals and two-tone submariners. Rolex's overall volume is just too big to steer desirability, and ultimately also too big to steer long-term, on average, value retention. If you have the titanium Yachtmaster on your wrist, it's going to be worth a lot more than retail, and it's objectively desirable from a value perspective. If you have that limited 10-month production run Le Mans Daytona, that's a desirable watch. But an Explorer 2? Not really. A two-tone? Not really. A Rolex is desirable if it's produced in highly limited quantities and distributed to a limited clientele. If you've got a Datejust or an Oyster on your wrist, you've got a great watch, but it's nowhere near anything you could call an investment at all. It's just like an Aquaterra. It's a good watch that will be worth less than you paid for it in a couple of years' time. It won't necessarily lose money as fast as a lot of other brands. Tudor dropped by 15%, where Rolex is only at 2%, but it's not going to appreciate meaningfully. That's fascinating to me. What are the takeaways from all of this? The Tudor hype is gone, and the question is, who's going to take their place? Patek have released a lot of watches that nobody really care about or particularly want, but the models that people want are hyper-limited and massively expensive in general and in the secondary market. Small overall volumes mean that those desirable models prop up Patek overall. And Rolex? Rolex currently as a brand isn't as desirable as the narrative that has been shaped would indicate. They have performed worse than the market in general when looking at their secondary market over the last 3 years. Their bread and butter perpetuals and Datejusts are what they sell tons of, and they don't drive desirability. Rolex is trading lower on average as a brand than they did 3 years ago before the peak insanity, and that's what it was, insanity. Rolex have always been a brand where you could easily get that Oyster or Datejust, and then it was harder to get things like the Daytona. And the insanity drove people to think that everything Rolex was amazing, and it wasn't. And now we're back. Daytonas and titanium Yachtmasters are still hard to get, but most everything else is turning out to be doable, as it always has been. And this relative availability is something that you can reflect on when speaking about Rolex's perceived desirability and exclusivity. For me, though, the biggest key points are two things. One, the market is still in a slump. It's tough times for luxury watchmakers. It's so clearly a boom and bust kind of business that never really learns from its mistakes. It's super hard for the working man in the industry that's on half pay right now. It's hard for the component manufacturers that are dependent on the luxury brands' orders. It's great for us because we get discounts. The most important thing, though, investing in watches is just a bad idea. Don't do it. It's a commodity. I chose Patek, Rolex, and Tudor for this analysis, but I could just as well have chosen AP, JLC, and Longines. The brands would have had slightly different stories individually, but the trajectories would have been the same. Are these brands doing fine financially? Tudor, Rolex, Patek? I'm sure they are. That wasn't the point of the exercise. The point was to peel back the veneer of branding and desirability and of how popular they really are or aren't relative to the perception. On top of all of that, the best way to invest your money would have been in the stock market or anything else other than luxury watches. You can buy any stock you want. You don't have to get on a waiting list to get a Tesla or a Novo Nordisk or Apple share. You don't have to choose between different Apple shares, of which some are scarce in availability. Your investment in a Rolex is massively dependent on getting the specific model that you want and desire at retail. That's not conducive to investing. You can't compare it to art investment either. There is, after all, only one Mona Lisa. So just get the word investment out of your head. Watches, especially luxury watches, are a silly use of your money. I use far too much money on these mechanical wonders, but I do it anyway because I've accepted that value in terms of return on investment is a myth for everybody except those people that can get a hold of a Journe or a Patek 5811 at retail. You're meant to enjoy your watches and not look at them like stock options. For me, I'm happy that discounts are back, but I do actually hope that we get back to better days for the industry so the regular Joe can get his full-time employment back and we also see more exciting watch releases. I hope you enjoyed the video. Let me know which watches bring you most joy in the comments. like, subscribe, and yeah, the watch I bought was a Pelagos FXD. Yes, I know, I've called it boring. I bought it anyway. I'll tell you more about it another time. Cheers.